Due diligence is one of those concepts that everyone claims to respect, yet very few truly practice when it matters most. Almost every painful investment story begins the same way. The idea sounded convincing. The opportunity felt urgent. Someone trustworthy vouched for it. The upside was clear, while the risks were vaguely acknowledged, but quietly minimized. In that moment, due diligence is often treated as a formality rather than a discipline, something to skim through quickly before moving on to the excitement of committing capital. And that is precisely why due diligence is not just important, but foundational, because it exists to slow you down at the exact moment when emotion is trying to speed you up. At its core, due diligence is the process of understanding what you are actually buying, why it might succeed, and how it could fail. It is not about proving that an investment is good. It is about discovering where it is fragile. This distinction matters more than most investors realize. People naturally look for confirmation, especially when money is involved. They search for data, opinions, and narratives that justify the desire to act. Due diligence, when done properly, does the opposite. It actively searches for reasons not to invest, knowing that if an opportunity survives honest skepticism, it is likely stronger for it. One of the most dangerous myths in investing is that due diligence is only necessary for complex or risky opportunities. In reality, the simpler and more familiar an investment appears, the more likely investors are to skip critical questions. Public stocks feel safe because they are well known. Funds feel safe because they are professionally managed. Friends' businesses feel safe because of personal trust. Familiarity creates comfort, and comfort dulls curiosity. Due diligence exists to counteract this effect, reminding you that every investment, no matter how common, carries assumptions that deserve examination. True due diligence goes far beyond reading summaries or marketing materials. It requires understanding the underlying economics. How does this investment generate cash? What variables does it depend on? What must go right for the expected return to materialize? And what happens if those conditions do not hold? Many investors focus on upside scenarios because they are easy to imagine. Fewer are willing to map out downside scenarios in detail, especially when doing so creates discomfort. Yet it is in the downside that the real cost of ignorance appears. Another critical aspect of due diligence is assessing incentives. Markets are shaped by human behavior, and behavior follows incentives. Who benefits most if you invest? How are managers compensated? Are their rewards aligned with long-term value creation or short-term asset gathering? Incentive misalignment is one of the most reliable predictors of disappointment. A brilliant strategy operated by poorly aligned incentives often produces mediocre or negative outcomes. Due diligence that ignores incentives is incomplete, no matter how impressive the numbers appear. Time horizon is also frequently overlooked. An investment that looks attractive over 5 years may be disastrous over 2, and vice versa. Due diligence forces clarity about how long capital will be committed, how liquid it will be, and what risks are being accepted during that period. Many investors experience regret, not because the investment was objectively bad, but because its timeline conflicted with their personal needs. Understanding this in advance is not pessimism. It is respect for reality. There is also a psychological dimension to due diligence that rarely gets discussed. Doing the work creates emotional resilience. When markets turn against an investment, those who understand what they own and why are far less likely to panic. They can distinguish between noise and genuine thesis failure. Those who skipped due diligence, however, are left with nothing but price movement to guide decisions, and price movement is a poor teacher under stress. In this sense, due diligence is not just about selecting investments, it is about preparing yourself to live with them. Importantly, due diligence does not eliminate risk. No amount of research can guarantee success. What it does is transform unknown risks into known ones. This transformation is powerful. Known risks can be sized, diversified, and accepted consciously. Unknown risks tend to appear suddenly, often when it is hardest to respond. Most catastrophic losses are not caused by risks investors knew and accepted, but by risks they never bothered to uncover. One of the reasons due diligence is often neglected is that it lacks drama. There is no applause for the investment you chose not to make. There is no visible reward for time spent reading documents, questioning assumptions, or walking away from excitement. The payoff is invisible, and delayed capital preserved mistakes avoided and peace of mind maintained. This invisibility makes due diligence easy to undervalue, even though it may be the most profitable activity an investor ever undertakes. Over time, disciplined due diligence shapes temperament. It replaces urgency with patience, curiosity with skepticism, and excitement with clarity. Investors who internalize this process stop asking, "How much can I make?" and start asking, "What am I risking, and is it worth it?" That shift alone dramatically improves outcomes because it aligns decision-making with survival and compounding rather than ego and impulse. As investing opportunities continue to multiply and information becomes louder and more persuasive, the role of due diligence becomes even more critical, not as a checklist to be rushed through, but as a mindset that protects capital and judgment and understanding how to apply due diligence. Practically what questions truly matter, and where investors most commonly fail to ask them, is exactly where the conversation needs to go next. By examining how to apply due diligence in a practical, disciplined way, because good intentions without structure quickly collapse under pressure. The first step is to clarify the investment thesis in plain language. If you cannot explain why an investment should work in a few simple sentences, you do not understand it well enough to risk capital. Complexity that cannot be simplified is usually a warning sign, not a competitive advantage. A clear thesis also makes failure easier to recognize, which is essential for managing risk. The next step is mapping downside before upside. Ask what could realistically go wrong and how bad it could get. Consider not only financial loss, but also time, liquidity, and emotional cost. Many investors focus on probability and ignore magnitude. A low probability event with devastating consequences deserves more attention than a high probability event with minor impact. Due diligence that does not stress test worst-case scenarios is incomplete. Incentives deserve focused scrutiny. Follow the money and the rewards. Examine how managers, founders, or sponsors are paid, what happens if performance disappoints, and whether they share downside alongside investors. Alignment is not about good intentions, it is about consequences. When incentives are misaligned, even honest people make decisions that favor themselves over capital. This pattern repeats across markets and cycles, and due diligence exists to recognize it early. Understanding the balance sheet is another non-negotiable step. Leverage amplifies both success and failure. Many attractive stories collapse under the weight of debt when conditions change. Assessing leverage covenants, refinancing risk, and liquidity buffers often reveals more about an investment's fragility than growth projections ever could. Strong businesses can survive bad years. Weak balance sheets cannot. Context matters as much as details. An investment does not exist in isolation. Industry dynamics, competitive pressure, regulatory environment, and macro conditions all shape outcomes. Due diligence means asking not only whether the investment is good, but whether it is good in this environment, at this price, with this capital structure. Timing is not about prediction. It is about margin of safety. Equally important is self-diligence. Investors must examine their own constraints honestly. How long can the capital be locked up? What level of volatility is tolerable? What happens if the investment underperforms for years? Many mistakes occur not because the investment was flawed, but because it was mismatched to the investor. Due diligence that ignores personal reality is incomplete. Documentation and repetition turn due diligence into a habit rather than a one-off effort. Writing down assumptions, risks, and decision criteria creates accountability. Reviewing past decisions, especially those that failed, builds pattern recognition. Over time, this process sharpens judgment and reduces reliance on excitement or persuasion. In the end, due diligence is not about being cynical. It is about being respectful of uncertainty. It accepts that the future cannot be known, but that fragility can be identified and avoided. Investors who practice due diligence consistently do not eliminate mistakes, but they make fewer irreversible ones. That alone is enough to dramatically change long-term outcomes. If this discussion reinforced the value of slowing down before committing capital, consider subscribing to stay with these deeper conversations about protecting judgment as much as money, and leave a comment sharing which due diligence questions have saved you from a bad investment, because learning from avoided mistakes is often more valuable than celebrating wins.